Let's say there's a 200-unit apartment complex, and on average, these units are rented $750 per month. And the property is incurring $840,000 of expenses per year. And the prevalent cap rate in the market is 6% interest rate. Bank is offering 5% with interest only option. So the total annual rent for the property will be 1.8 million. And subtracting the annual expenses, we get net operating income of $960,000. So the fair purchase price for the property in that market will be 960,000 divided by 6%, and we get $16 million. Planning for reserves and contingency funds, let's say $400,000. Funds required for acquisition is 16.4 million. Now, how is this equity raised? 70% of the value, so 70% of 16 million, not 16.4, because property is appreciated as 16 million. So 70% of that is provided by bank, and rest of the capital is raised in form of common equity from investors. In order to raise this amount, sponsors offer 5,200 shares in the partnership, each share for $1,000, and they offer 70-30 straight split profit sharing scheme. Mo buys 100 shares of investment for an investment of $100,000. So looking at the baseline, when we bought the property, net operating income was $960,000, and the loan payment now is $560,000 at 5% of the loan amount. So the net income when we purchased the property was $400,000. So this is how we got the net income, and let's see how it changes over the years. Over the years, in a good market, it's very fair to assume a 3% of rent increase every year. And even though expenses grow a little slowly, but let's just assume 3% here, and 5% is interest rate. So rental income goes up by 3% every year. Expenses go up by 3% every year. Net operating income also increases in line with those increases. And after paying the interest, this is our net income. This is what numbers look like when we purchase the property. And this is how the net income has increased from year 1 to year 5, from 428,000 to 552,000. So what do investors get out of that? Our Mo, let's look at that. So net income in year 1 was 428,000, and sponsors charge 1.5% as fee. So taking that fee out, this is the cash flow which is available to be distributed to partners. Applying 70% for investors, we take 70% of cash flow. This is the amount that goes towards investor, and rest is distributed to the sponsors. Out of this, because of the total $5.2 million equity, Mo had invested 100,000. So this amount divided by 52 will give us the Mo's income in first year. And Mo made a cash-on-cash return of 5.69% on his 100,000 investment. And then year 2, year 3, similarly, his cash-on-cash return along with the income goes up. Let's say at the end of year 5, when our net operating income is $1.1 million, sponsors decide to sell the property. So net operating income divided by 6%, this gives us the sale price for the property. This is the sale price at which property is sold. So out of this 18.5 million, 11.2 million was the loan payable to bank. So that amount is returned to bank. And 5.2 million that was raised from the investors, their original amount is returned. That's where Mo gets his original $100,000 back. And remaining profit, out of the 2.1 million remaining profits, 3% disposition fee is charged by sponsors. Rest of the profits are distributed according to the agreed upon profit split share. 70% goes to investors, and Mo gets 1/52 amount of this, which is $21,000, and his return on from sale only, he made 21%. So this shows how much Mo made from the whole project, syndication project. Year 1, to year 5 cash flow, and then the proceeds from sale. Now let's consider what would happen if the sponsor had actually planned to increase the rent to bring it to par to the surrounding properties, which are renting for $900 per month. First of all, they would have to, even before acquiring, they would have to budget for the value add expenses, estimating an average of $8,000 per unit renovation cost. For 200 units, it will be 1.6 million. Adding 400,000 for reserves and acquisition, that the total acquisition cost is 18 million as compared to the original 16.4 million. And then because bank will only fund based on the property value, which hasn't changed, rest of the increase has to come from the more equity raise. So instead of 5.2 million, now sponsors need to target to raise 6.8 million of equity raise. Let's say Mo still invests same $100,000 in the investment. His share in the equity is 1/68 instead of 1/52 in the original example. This is the net income. So this is how the numbers look. Rest of the assumptions are same, and net operating income and net income, they will be different, but you need to pay attention here, like year 1, because when the renovation is going on, for renovation, the units have to be vacated. So the vacancy will go up in year 1, and that means less rental income. But the good news is year 2, the income significantly goes up because the renovated units are now renting at $900 instead of $750 per month. And then for rest of the duration, they still continue to go on with market 3% per year. So let's look at what it changes for Mo. So applying same calculations, Mo's return in first year is low, 1.98%, but then it goes up to 7%, 7.19%, and eventually until year 5 when he gets 8.38% cash on cash return. After 5 years, the property is sold. So net operating income at the end was $1.38 million as opposed to $1.1 million. And sale price, instead of 18, because of the increased NOI, the sale price has gone up, significantly up. And the equity is returned. Of course, that number will be different and profits will be higher. Instead of 2.1 million, now the syndication made $5.1 million of profits. Taking disposition fee out and distributing according to the profit sharing agreement, Mo makes 45.45% in this case. Compare that with the organic appreciation. So this is how Mo's returns change from organic appreciation to forced appreciation scenarios. Overall, average annual returns in first case were 10.78%. Forced appreciation, the average annual return was 15.71%. Here are the other metrics we talked about. Average annual return, equity multiple 1.54 in this case, 1.79 in the forced appreciation case, and IRR is 9.92% and 13%.